Hello students, I am Hasmathullah from G.K.Jain school. Today we are going to take the fourth lesson of 11th standard, which is cost and revenue analysis. Okay. Before going to the chapter, let's see what is cost and what is revenue and how it plays a vital role in any business concern. See, business is a part of a money aspect. Without money, business cannot run, right? The same way, money is what? A cost. Everything should have a cost value. Everything should have a value. When there is a value, the thing will have their own aspect and the thing will have their own opinion, the thing will have their own value. So, value means in terms of money that you can express in a term. For example, when you have any product with you, for example, you have this marker with you. When you have this marker along with you, when there is a price for this, when there is a cost for this, you can sell in the market and this will have a value. When this is a cost free, the same value will not be there when you have paid and get the product. That's the reason the cost plays a vital role. And what is revenue? The thing, the profit that you generate from the any product, that is what we call revenue. Okay. So cost and revenue plays a very important role in any business concern. Without these two aspects, you cannot simplify the business activities. In economic activities or any activities that has a connection with the minimum of selling and buying. When there is a buying and selling, there must be what? A cost should be there and a revenue should be there. So, who are selling the product, they should have the value of the product. They should have the cost of the product and as well as they should also generate some of the profit. That is what we call revenue. Let's go to it. There are two factors which maximize the profit in the firm. So, if you want the maximum profit in your organization, you should do the two things. That is, there should be a cost for the product and there must be a revenue from the product. Cost for the product, revenue from the product. See the difference. Cost for, which means there must be a cost with the product. Revenue from, which means from the product you get the revenue. So these two aspects plays a vital role. Cost and revenue. So when you want your organization or the business or the small industry to get developed, to have the extra benefit, to have the extra profit, you must have the two aspects that are cost and revenue. Let's see what is cost. Revenue aspect we'll see in the next classes. Cost refers to the cost of production. So cost means what? A cost of production. So when you have manufactured the product, when you manufacture the product, for the manufacturer of such product, what cost you have bear? For example, I am the manufacturer of glass, a mirror, okay? Mirror industries I have. For making a mirror, I have how many cost of production I have used? What kind of cost I incurred? What cost I have incurred for the land? What cost I have incurred for the labor? What cost I have incurred for the capital? What cost I have incurred for the organization? So, what investment I have put in it? What kind of wages, incentives, extra wages, outstanding, all these things I have given to the laborers, capital. And what are the land, the rent I have given up, or I have the lease amount, or whatever it may be, or the organization aspect and the registration fees for the office and all the various fees, GST fees, and tax, direct tax, indirect, all these aspects. So that is what is say, cost of production. See the word cost of production. So cost means any cost that you incur, a money that you have incurred while making a product. You have made one product. For example, you have made a chalk piece. A chalk piece you have made. For making the chalk piece, what kind of expenses you have incurred? That is we call as cost. Understand? Cost means any expenses that a person gets by manufacturing that product, the particular product is known as cost. The total expenditure incurred in the production, which include all the payment made to the factors of production, which means whatever expenditure you have done, whatever from the A to Z, whatever you have made any expenses, that expenses which has the link with the factors of production, and this expenditure and all the payments you have done. The payment may be a salary, the payment may be a wages, the payment may be a rent, the payment may be a GST council fees, anything, whatever you have done for that product. I have made this marker For making this marker, whatever I have paid the patent right, I have paid the employee fees, I have paid the rent in the organization where I have manufactured. So all the expenses related to this marker will be known as cost. Will be known as cost. So this cost means nothing but whatever expenses, every paid expenses, every paid expenditure, every paid output of the factors of production that take place in a product, that is called cost. Okay? This cost in the economics aspect have been segregated in the various aspects. Okay? But regards to our theory, with regard to our person, we have some of the costs that we are going to study. Real cost, money cost, economic cost, social cost, opportunity cost, sunk cost, floating cost, prime cost, fixed cost and variable cost. This is the part of our syllabus. We have many costs, around 20 to 25 costs is there. Let's see one by one. Real cost, the sacrifice made during the production. So the real cost is the original cost value that a product is used to make. Okay? For example, I have made this marker. For making this marker, what is the original price I have incurred? For example, making a product, I have got 5 rupees. So this 5 rupees is the original price I have incurred. So with the 5 rupees, I have made this marker. So this is what? A sacrifice that you have made for the making the product. So original product, the real fact, the real price of the product is known as real cost. So this is the real. But in the market, you will not sell for the 5 rupees. You will sell it for 10 rupees, 15 rupees, 20 rupees because your profit will be inserted. So whatever things you have incurred, whatever you have done for making a product, and the real value of the product is known as real cost. Real cost means the original cost. You can write it. The original cost of the product is known as real cost, which is made during the production. Okay. Next, money cost. Money cost means for making this marker, I have done the labor. For labor, I will get wages, right? For making this marker, I had the a room or a business industry or a setup of place where I have made this marker. For that, I will pay a rent, right? Like that, various interest is there. So, money cost means all those aspects, all those expenses that I have earned, I have incurred while making the product. For example, for making this, I had a 4 expenses. For what? Land. For land, I get a rent. Labor. For labor, I get wages. Capital. For capital, I give interest, right? So, all these things is known as money cost. So, the money related expenses is known as money cost. So, cost consists of wages, rent, interest and extra. All this is known as money cost. Simple. This money cost is segregated into 2 parts. Explicit cost, implicit cost. Explicit cost means payment made by the producer to the owner of the factory. So, the explicit cost means the payment the producer will make to the factors of production. So, I am the producer. I am the producer of the product. For example, we have taken the example of marker. So when I am the producer of this marker, I will pay to the all the factors. So whatever factors is inserted while making this marker, I will include this and I will make. That is what we call explicit cost. Implicit means factors which are owned and controlled by the producer. And implicit means all those factors which is owned by me, controlled by me, where I will not have expense, where I will not pay the amount. So, for making this product, there are certain factors for which I pay money, that is called explicit cost. Some factors there for which I don't pay money, that is called implicit cost. Simple. When I pay, it is explicit cost. When I don't pay, it's a implicit cost. Simple, you write. When producer pays, it's known as explicit cost. When producer does not pay, when producer owns the product, that is known as implicit cost. Simple. Then we have economic cost. All payment made to the resources owned and purchased by the hired of the firm. So all those expenses which a producer make to hire the firm is known as economic cost. It is nothing but a simplification of explicit and implicit cost. When you add explicit and implicit cost, you will get the economic cost. Next, social cost. Social costs are those costs which a society is incurred. For example, there is a society. For example, cooperative society is there. The cooperative society, if they manufacture any product, they should bear all the money. That is what we call them. For example, any product is there that is made by any particular community, any particular society. That society will incur all the road. That cost will cause social cost. Okay. the benefit, the reason for doing that will be a social welfare. Okay? Opportunity cost. Revenue foregone by not making use of alternatives. In a business, you will have many ideas, many rules, many policies. When you forget one rule than other, that is what we call opportunity cost. In a business, you will have a different type of opportunity. You are doing a business of clothes means you will have a simplification, specialization in a woman clothing or a men clothing. There you have the alternative resource. When a person does not know how to use the alternative resource, for example, they are doing the men clothing business and they does not know the women clothing business, that's the reason, that's what we call opportunity cost. You have the opportunity, you know the opportunity, you know how to grab the opportunity, but when you forget to take that opportunity, that is what we call opportunity cost. Such expenses in also opportunity cost. Next, sunk cost. These are the costs you have incurred in the past. For example, in the year 2018, you have incurred some of the cost. You have 50,000, you have made some payment. That payment is known as sunk cost. That cost is known as sunk cost, which means we have done in the previous year, on previous time, which cannot be settled in this year. That is what we call cost incurred in past, which cannot be recovered in the future. It's already done in the past, so it cannot be done. That cost cannot be derived in the future. Floating cost. All expenses directly connected with the business activity. These are the costs which is increased in the business activity. So day-to-day business activities is there. The running of a machine is there. The paying of the wages is there. All the medical assurance is there. So all those actives that's needed to run the business daily. That is what we call floating costs. Every day, tea expenses, machine repair expenses, or small expenses. Those costs are known as floating costs. Next we have prime cost. All costs vary with output together with the cost of output. Here in the prime cost, the objective cost, the main cost. Prime cost also known as main cost. This is what every cost that has the connection with output. So bringing the any product, the output volume is there, right? In that, when there is a connection of administration, so when you add the cost of administration with the output, that is known as pricing cost. Prime cost can be calculated at variable cost plus cost of administration. So all the costs which are changeable, which are always changeable. For example, paying the wages, it will get changed. Buying the machine, the rate will change. Along with that, the administration cost, when you add, you will get the prime cost. Next we have fixed cost. Fixed costs are those costs which cannot be changed over the period of time. It will remain same. What is it? Cost which does not change due to change in the quantity demand. So when there is a 5,000 quantity demand of any product, the price was 100 rupees. If there is a 10,000 quantity demand, again the price will be 100 only. Only the same. So the price, the cost of the product remains same. Why? Because this is a fixed cost. Fixed cost means the price of the commodity, the price of the product, the price of the goods remains same, although there may be an exchange of quantity. Next, variable cost. It means vice versa, opposite of it, it will get changed automatically. When there is a seasonal advantage, there will be change. When there is a extra demand, there will be a change. When there is extra supply, there will be a change. Change may be a positive or negative. So these are the various costs with regards to the cost and revenue analysis. In the future class, we'll see the short run and see how the curve plays a vital role in the formation. Thank you, students.